Good morning. Welcome to Trading Hour. It's a Tuesday morning. It's a positive start. The Nifty and the Sensex are up close to about 0.2%, but the action once again is in the broader markets. The morning has been steady, but look at the mid-cap index. The mid-cap index is up close to about 0.7%. The small-cap index will also come up for you on your screen. We've got a positive advance decline ratio. Like yesterday, it's about 2 stocks gaining for 1 in the red. In terms of the big sectoral movers this morning, keep your eye out on all the telecom names. There's some massive buying which is visible in Vodafone Idea, so that's a big mover. Bharti Airtel in the large cap space is up 2.5%. Indus Stars is up 2.7%. So Telecom as a sector is flying quite high post the successful closure of Vodafone Idea's massive 18,000 crore rupee fundraise. Real estate is the other pocket where there is a lot of buying. So the Nifty Realty Index is up nearly about 2.5%, and FMCG to some extent is also leading with the Nifty FMCG Index up half. Hi, Subhi, how are you feeling?
Hi, Rima. Oh, slightly better, trying to get my voice back. But yeah, I mean, it's been 2 good days for the market. We've come back from the midweek disruption last week where it was all about geopolitics. And right now, it's very, very clear. Market's got its eye on individual stocks that are moving. It could be earnings reactions, it could be news. I'll just point out some of the movers and shakers because there is such outperformance. The mid-cap index is up about 0.7%, and the Nifty is now flattening out. So just to talk about some of the outperformers, look at a stock like Honasa. Honasa Consumers surging about 8% higher. Of course, Rima was talking about Telecom. Vodafone Idea itself is having a great session today, about 6 to 7% up on Vodafone. Some of the PSUs and the shipbuilders, they're having a very good morning. So Mazgaon Dock, 4.5% higher. Cochin Shipyard, about 7 to 8% higher. So these are names that really stand out. And then, of course, there are strong earnings reactions. And today's star really is Tejas. We'll talk about that stock as we go forward. Tejas Networks has come out with a blockbuster of a set on the top line, and they've got profits now. The company was in losses for several previous quarters, but that's turned around and the market really likes the sight of that. But before we talk about more secondary market action, let's actually kickstart the show by talking about what's happening in the primary markets. And there's a new kid on the block very, very soon. I'm talking about another IPO that's making its way to the street. The IPO is Maharashtra-based heating equipment company, J&K India. Now, this is an issue that is opening today. The company has fixed a price band of 395 to 415 rupees per share, and this is 650 crore IPO. The closing date is 25th. It's a mix of, a fresh issue as well as offer for sale by existing investors. We have with us the company's management, Chairperson Arvind Kamath and CEO Deepak Bharuka of J&K India. Gentlemen, thank you very much. Thanks for joining in. We were just going through some of the details of your company. You seem to be in a very niche space and you have a lot of market dominance, right? Because you make heating equipment which refineries need, which petrochemical plants need, and a whole lot of other industries. So just go over the details and, whether you expect to keep maintaining the market dominance that you currently enjoy.
Yes, Surbi, absolutely. As you stated, the new kid on the block, it's apt because we are like a 13-year-old kid in the candy store now. So, yeah, I mean, we are dominant in the refinery and petrochemical market in the India. But not only in India, the export market also great opportunities there going ahead. So, our TAM for next 5 is something like 63,000 crores. Okay. That's as per the F&S study for the 5 years cumulative analysis. So, hope that, there's a great runway ahead for us.
The 63,000 crore of TAM, is it domestic or is it including exports?
It's a global.
Both put together.
And you've also said your market share is 27%.
It's only domestic.
That's a domestic market share. Yeah. Okay, right. Got that. Also, if you could just talk about, we were having a look at your numbers. In 9 months, FY23, sorry for jumping straight into the financials, it's about 253 crore, which compares with FY24 revenues of 400 crore. So simply doing the math, it would appear that FY24 revenues might fall short of what you've done last year, while margins have expanded. So can you explain that for us?
Yeah, Lina, I mean, see, in our business, quarter on quarter, it kind of depends on the what projects are dispatched and what execution is there. Last 3 years, if you see, generally, first 3 quarters and the last quarter, the ratio is about 50-50 or 40-60 or 60-40 that way. So the large chunk of revenue gets booked or shipped in the last quarter.
Okay.
So,
but even if
yeah,
you assume 60% of your revenues come in, it would still mean a flat or a minor growth, right, in FY24 versus FY23?
Not really. I mean, we're not like allowed to say the exact figures because it's not yet in RHP.
Okay. But is there some slowdown that we've seen?
No, not at all. Not absolutely not. We're looking for a great growth ahead. Yeah.
Okay, let me now talk about the margin improvement that you've showcased in 9 months. It's very, very substantial, right? Because you were averaging around 17-18%. Then 9 months of the previous fiscal, you've touched 26%. So what changed? And is this sustainable?
Yeah, see, when it comes to the margin, it is unfair to look at the quarterly margin. For our kind of business, you should always look for the yearly margin.
Which has been 17 to 18% for your business.
When at the end of the year, we will probably surpass it by a couple of percent, but then 27% is more on a 9 month, which we had to declare to the SEBI at the time of filing our
so annual margins will be expecting to hover in that same range.
Steady or a couple of percent here and there.
17 to 18. So, okay, let me try now, get a little away from the numbers to understand, again, the business dominance. You have a lot of the large conglomerates which are your clients. Right. I suppose Thermax or maybe BHEL, they're in the same space as well. So what about competitive intensity? Do you have any levers to charge more for your products and services? I mean, I'm now talking about a 3-year trajectory in terms of the revenue and the margin profile of the company. What can shareholders expect?
Yeah, basically, see, the space which we are in is a completely engineered and fully custom-built equipment. So it's not that there are not so many competitors in this space who have got references and already credibility in this very proven, only few companies in Europe. Okay, there is competition, as you said, in India to a certain extent in the basic equipment, that is fire heaters. But we also do reformers and cracking furnaces, which are more high-end, and there is no Indian company in this space, basically.
And from what we gather, you're looking to go big on the electrolyzer and the hydrogen space as well, right? Just explain your presence there right now, because that's the big thrust. For instance, Reliance is setting up such a huge factory at Jamnagar, right, on this. So what is the potential on green hydrogen?
See, to start with, currently we are executing India's first on-site generation dispensing hydrogen station for ICL in Faridabad. And going forward, we see this space will show a lot of growth in India, and otherwise also, if you see in Korea, there are almost 200 plus hydrogen fuel station they are having. And when a country of that size having 200, you can do the math for what numbers will be coming up in India. But we see it will take another 3 to 4 years for that space to really grow and give us the substantial revenue. But we are doing our R&D and we are making ourselves competent to handle this project when they come.
Just a final point to understand again the margin profile. When you supply heating equipment for the green hydrogen industry, does it typically fetch better margins or is it at par?
Green hydrogen industry does not require the heating equipment. It is a different space altogether. For the heating equipment space, yes, our margin profile is as historically we have depicted, and it is mainly because of the competition. We hardly have any competition from India. The companies which we are talking about, big conglomerate, they are big in some other sector. They are not so big in the sector where we are having a dominance. Our competition is mainly with the European companies. And because we don't expect many new companies to come because of the entry barrier. See, our main USP is we have crossed the entry barrier if you see our growth, in last 3-4 years, it is phenomenal. Before that, it was quite sluggish. And this main reason is we have crossed that entry barrier combined with Make in India and other factors that is giving us the edge over others.
Okay. Are the margins similar between exports and the domestic sales?
More or less, but yes, in the export you can expect a couple of percent more because all export orders are in US dollar. And then again, competition is altogether different in the export
So how much
market.
better are export margins? 200, 300 basis points higher?
Couple of percentage you can say.
Percentage points. And also your mix between India and overseas has changed dramatically. So FY21, India was 36% of revenues, which has now moved up to 80%, 81% in 9 months.
Yes,
so can you explain that?
I mean, generally we've been like last 3 years, if you see, 60% has been exports and about 40% has been domestic. Only these 2 years would be, it's flip, I mean, vice versa. Yeah, because of the Make in India, we got, accepted with a lot of opportunities with the PSUs in India.
Is there a PLI scheme for where you operate? Or
No, not really. But then Make in India, what they did is all this heating equipment business earlier, because it up to around 200 crores, 250 crores kind of inquiries, they would send global inquiries because there are not enough companies in India who make this. But because of Make in India, we would got qualified and, quoted for these jobs. And that's how we're executing a couple of jobs for Indian refineries now. But going ahead, the opportunities is more in export. So we see a similar trend going ahead.
And
So
what's the mix then? What's the mix that eventually you will have, domestic and exports
I think
mix?
could be about 50-50 or exports could be about
Going
60
forward.
or so. That's the, yeah.
Okay. Just one more question. Since you're saying that the company's orbit changed in the last 3 years, right? And you've developed a moat around yourself, So can you tell us, in the last 3 years, your domestic revenue growth was 59%, export revenue growth is 79%, I believe, right? Is this the run rate we should expect, going forward? And also, is there scope in the long term for you to expand margins? Is there anything in your business plan which allows for margins to cross to 20% plus sustainably?
See, on a sustainable basis, as Arvind explained in the start itself, total market TAM is around 70,000 crore globally. And you can do the kind of turnover we are doing, revenue we are talking now and future. And we'll be qualified and eligible to do most of these projects which will be coming in the India and in the global space. So definitely, as we go ahead, we don't expect some drastic change in the margin either way, but we are confident that we'll be able to maintain the margins as going forward.
Just one last question to go back to the hydrogen business. So you have a lot of dependency on traditional oil and gas refining right now, right? I think over 90% of your business comes in from this sector, if I know the right numbers. But just tell us about business de-risking plans going forward. And you are also apparently looking at technology tie-ups. I'm not sure whether it's electrolyzers and hydrogen or some other space, and also acquisitions. Just an outlook on how will the business look in terms of the mix across different sectors and verticals.
Yeah, see, basically, oil and gas is refining is one part of the business, but there's a lot of scope in fertilizer and petrochemical space. Actually, a lot of opportunities are coming in India in petrochemical. We still very comparing to the production and consumption of petrochemical, India is still at a very nascent stage comparing to the developed countries. So in petrochemical, our capex in terms of the cracking furnaces has large opportunities, and even fertilizers which are coming up a lot in Africa and the other Eastern European or Australia or Indonesia. So there are a lot of opportunities for reformers in these countries as well. Yeah.
Okay, so oil and gas, petrochemicals, fertilizers, three big sectors for you.
Absolutely, yeah.
And green hydrogen, don't forget.
And green hydrogen, yes, as and when that kicks off. But do you have a timeline for that? I mean, by when do you think that
No, there are a lot of initiatives, maybe, but we expect another 2 to 3 years' time, it should give us the big business as we move forward.
Okay. All right, gentlemen, thank you very much for joining in. Good to have you in the studio and good to understand your business, and all the best with the IPO plans.
Yeah.
Thank you.
Thank you.
Well, with that, we do have to take a very quick break. Come back on the other side. We'll discuss commodities and all that's buzzing. Manisha Gupta is going to join in. Welcome back. Let's shift the focus to the commodity space. As promised, we have Manisha joining in. She's looking at the big moves that are happening on the precious metals side. At least in the last couple of days, they've not just been unidirectional moves. There's been some profit taking. But Manisha, what's the latest?
Oh, well, yes. Earlier we were talking about one-way move, and that was only on the higher side, where we made all-time highs in case of gold, 3-year highs in case of silver. For the Indian market, silver prices also hit an all-time highs. But we see these prices now retreating from its all-time highs. The kind of drop that we saw in gold in last 24 hours has been the biggest that you've seen perhaps in 3 years. So that's the kind of speed that we've seen the prices come off as well. But of course, when you look at on a month-on-month basis, 3-month basis, we are still much on the higher side even now. So overnight, we've seen silver prices decline by 5% and gold has come down by 2.5% as well. And that was yesterday in New York session. Today in Asia, we've seen some more profit taking continue for both of these commodities. So when you look at in exact number sense, we've seen the gold prices come off. Silver first, and silver has come off from 28.9 to 26.9, and gold has come off from an all-time high of $24.20 to below $2,300 an ounce as well. There have been various factors that have led to decline in prices. To begin with, it has been investors taking profit and portfolio managers repositioning now because of the kind of increase in value that you saw in case of gold and silver, both there. Apart from that, it's dollar index and the US yields, which have also surged on the back of strong US data. There are now statements coming in from various Fed officials on prolonged restrictive policy. So the first rate cut could actually come in not in June, but in September, and that's weighing onto the markets. Israel's restrained response to Iran's missile and drone attacks also tells you that the Middle East tensions kind of seem to be de-escalating right now, and that premium also seems to be going off the prices. And then it also is about the global central bank, which the markets do believe that for the month of March and April has been kind of sustaining and not looking at further increase. It also has to do with the kind of curbs and restrictions that the exchanges put forward, because when you look at CME margin hikes, there were 2 of them in the last couple of months, and China trading curbs has been yet another reason that you have seen some of this activity come off. This is what Citi came out interestingly with its report, suggesting that a minor pullback in gold and silver prices is what you will see by the time the second quarter ends. But for the second half of 2024, they have put higher targets for gold and silver. Both $2,500 per ounce would be another all-time high for gold, and silver is anticipated at $30 to $32 an ounce. So the direction of gold and silver has not changed, but this is a correction which was overdue.
Okay, thank you very much for joining in, Manisha. We'll get into a break. On the other side, we'll be joined by the management of Tamil Nadu Mercantile Bank to discuss their Q4 numbers. Stay tuned. Welcome back. You're watching Trading Hour. Let's now get a corporate conversation going. Another one. Tamil Nadu Mercantile Bank is on our radar on the back of its Q4 numbers. The bank's net interest margins improved to 4.24%, which compares with 4.04% a quarter ago, though it's lower compared to year-on-year. Profits have declined both annually and on a sequential basis. To discuss the numbers and the way forward, we're joined by S. Krishnan, MD and CEO of the bank. Mr. Krishnan, morning. This is Reema here, and thank you very much for joining in. First, if you could explain the sequential improvement in your net interest margins, is it sustainable, and what can you guide on margins going ahead?
Thank you, Reena. Very good morning. As far as the net interest margin is concerned, the net interest margin has been the last year, 23-24, has been consistently on the upward movement. To recapitulate, I can say that in Q1, the net interest margin was 4, it moved to 4.1, and in Q3 almost at the same or a little less at 4.08, and Q4 we could get 4.24. This net interest margin we were able to have because one, we are very cost conscious. That is the reason that we have been utilizing the funds available with us to a great extent, leveraged that, and had a CD ratio of 80%, which was very comfortable. And going forward, I expect that my net interest margin will be definitely 4+. That is what the guidance I gave last year also. And we are able to. Of course, when I compare this net interest margin for the year 23-24 with the previous year, it has come down. It is basically because the entire industry, the cost of deposits had gone up. And TMB is not an exception. That is the reason. However, we see that it is stabilized and we will be able to maintain this. Again, for the guidance, I can say that I'll be able to maintain NIM of 4+.
Okay, Mr. Krishnan, so your shareholders will like that you're saying that NIMs will remain at 4+, but then you're saying that the next couple of quarters there will be a slight moderation because, I mean, at the end of Q4 FY24, you were at 4.24. So yes. Fair to expect a 20-25 basis points sort of a moderation?
No, I don't say moderation. In fact, I may be able to maintain, but we have to wait and watch how the interest rate moves. Because now there are, as of now, if I take, yes, currently it may be flat. I don't expect that the interest will move northwards immediately. I also don't expect that there will be a rate cuts in the near future. That is my expectation. If that being the case, the net interest margin will be hovering around this. But as a range, I said that it will be 4+.
So just to go back on the asset quality point, your write-offs quarter on quarter were slightly higher. You had write-offs of about 53 odd crores. So can you give us some idea about the, the expected rate of slippages going forward and whether write-offs will continue to remain high in the coming quarter as well?
See, as far as the slippages is concerned, I can say that the slippages are very much contained. My slippage ratio for the full year is 1.36, while for the quarter it is only 0.16. In fact, in Q2, we had a little higher slippage. That is the reason it went to 1.36 for the year. Otherwise, the slippages are always under control. I will like to draw the reference to the SMA book. The SMA book, which was 6.51, has come down less than 4% now. That clearly indicates that, yes, we are able to have a better loan book. And going forward, my slippages is expected to be very minimal. I don't expect big accounts which are in the radar of slippage. As I said, SMA was 6.51 previous year, and 23-24 March, it was 3.97. That clearly indicates that we are able to have a better asset quality. Going forward, the slippages are expected to be the minimal.
Write-offs, sir? I mean, as I said, write-offs were quarter on quarter, they were more than usual. So why the high write-offs?
Yes, no, write-off I don't expect in coming quarters to this extent. Probably whatever was there, we were clearing the balance sheet, which were fully provided already. So we have done that, and I don't expect that there will be further more write-offs like this.
So then, sir, let's talk about the business now, the growth of the book itself. Your advances quarter on quarter were up about 4.2%. I mean, when we're looking now, we're talking about FY25. What is the visibility, or what's the target you've set for yourself in terms of growth in advances?
In terms of growth in advances, it should be 12 to 15%. That is what I say that we will be able to do. Why? I can say that the year 23-24, the bank had undertaken a transformation project. We have been transforming the processes and also the products. We had put in place various systems. Basically, the bank focuses on the MSME. So we took the business process engineering first phase for the MSMEs. We have established the MSME hubs in different locations. I have 12 regional offices across the length and breadth of the country, of which 9 locations I already established the hubs. So the underwriting process have been centralized in these hubs, which will ensure the quality of the underwriting. So that going forward, my asset quality is ensured. Second, we have also put in place a relationship manager's role, where I am assigning the customers to specific officers who will be the relationship managers for them. And I'm also having this year the plan of having feet on street for lead management. So these things I expect that will come handy for the bank to see that we are able to achieve the estimated level of around 12 to 15% in this current year.
So loan growth guidance you've shared, can you share do you have a deposit growth guidance in mind?
Deposit growth also will be around that. In fact, I will be having a business strategy meeting of the board very shortly, after which definitely I will be able to give the detailed guidance to the street. But I think that the estimated deposit growth will also be around 12 to 15% by and large.
Okay. All right, so we'll leave it on that note for today. Thank you very much for giving us more details on the business at the end of Q4. There you go. That's Tamil Nadu Mercantile Bank. We have to take a break, but before that, let's focus on some more stocks that are looking very interesting, and they're buzzing on either, news flow or results. And 2 of them would be Hudson Agro. That stock zooming about 10-11%. And the other is Tejas Networks, which is now clocking a near 20% rally. So we promise we'll tell you more about them. Let's get to it. Rima, so what has Tejas done so dramatically right this quarter? I mean, the numbers look good, and look at the stock flying away.
Well, so this is first, about a company which makes equipment for telecom companies, right? For networking particular, like routers, switches, etc. For wireless and wireline. And the company has been a beneficiary of Make in India. They participate in the PLI scheme, so they get incentives on the back of that. They've also been a beneficiary of moving away from China. there is hope that because Tatas are getting into semiconductors in a big way, maybe some orders will flow on the back of that. BSNL, BharatNet. So, the company has been a beneficiary of all that. In the last couple of quarters, the company struggled because they didn't get the required, some of the raw materials because of the entire, the global crisis. So they were not able to execute the orders on hand. So that's the reason why the company was sitting on very large inventory and they were reporting losses. Also bear in mind that Tejas Networks Q4 is the strongest quarter. But that said, even if you take into account, if you strip out the seasonality associated with this, these are very strong numbers, right? 137% up on a quarter-on-quarter basis and 343% on a year-on-year basis. The company's clocked in an EBITDA profit of 150 crore, bottom line profit also 146 crore after 5 consecutive quarters of losses. The order book has been very strong for the company in the last 3 quarters. It's been close to about 8,000 to 9,000 crore over the last 3 quarters. This is on account of that BSNL. It was a large BSNL deal which pushed up the company's order book. The cash position is at about 641 crore rupees. And just to put into context the company's performance in the last couple of years too, this time the company's revenues have more than doubled in FY24 because of the strong showing. Before that, for FY20, 21, 22, the revenues were flattish, 400 to 500 crore. It inched up in FY23. And now they've further gone up in FY24. And even on the bottom line, the company reported losses in FY22-23 despite an improved revenue. But in FY24, the company has reported a profit of 63 crore.
Okay, that's Tejas Networks for you. Stock is doing really well. And in the last 1 year, the stock has put on about 71%. So it's not been a massive outperformer.
In the last 2 days, it's up 40%.
Exactly. So
if you strip that out, it would have been a flat performance still day before.
Which is exactly what the chart says, that this is all about what's happened now in the last couple of days. Otherwise, this was an underperforming stock if you look at the rest of the mid-cap mania that played out in the market over the last 12 months. So big catch-up by Tejas Networks today. Let's also talk about another stock which is also reacting very well to the quarterly numbers that have come in, and that's Hudson Agro. The stock is gaining about 10-11%. The company has continued a good show in the 4th quarter. Reduction in milk prices has aided the EBITDA. The PAT has doubled on margin expansion. Earlier in the day, we caught up with the company's chairman, R.G. Chandramogan. Listen in to what he had to say about the business performance.
Normally, January, February, March is our lean month, where procurement will be going down and the sales will not pick up because summer has not come. This time also the same thing, but summer is expected to be very hot, but we are prepared for the summer. We have already done a good procurement of more than 20%, and we are sitting with enough stock to manage the supplies in the summer without any difficulty. And 25-26, we can think of anywhere between 15 to 20% growth. 1.5% we can increase from the present 11.2.
Okay, those are 2 solid result reactions playing out today. We'll take a break on that note, come back on the other side, and we'll discuss the market's technicals. Mitesh Thakur is joining in with some trading ideas. Welcome back. Here with us on Trading Hour. We're analyzing some more stocks that are in focus today, and M&M Financial is one that's been under pressure. The company informed the exchanges that a fraud to the extent of 150 crore rupees has been detected at one of its branches in the northeastern part of the country. Abhishek is joining in with more details. This is a matter that's still under investigation. Abhishek, clearly the market's not too happy with this.
Well, M&M Finance has deferred their board meet to a later date. They were to announce the results today for their Q4 FY24 numbers. There has been a fraud which has been detected in one of their branches in the northeast, and this is with respect to the retail vehicle loans that they have given out. So fraud involves forgery of KYC documents. The expected financial impact is about 150 crores, which forms about 21% of the Q4 FY24 estimate of PATs by analysts, and I spoke to a few analysts. They say that the average ticket size is about 3 to 4 lakhs. So this could be around 3,500 or 3,750 to 5,000 vehicles, which could be the range with respect to where the fraud has been detected. So necessary corrective actions have been identified, and the persons who are involved have been arrested. Also, we have brokerages who have written on this. Investec says the amount forms 15% of Q4 FY24 PBT and about 6% FY24 PBT. IIFL Securities has written, they say that the quantum of fraud is about 3.7 times to the disbursals to per branch. So the amount seems to be very large for a single branch, and it may have been perpetuated over a few quarters or few period. So growth can get impacted in the near term as the management continues to focus on tightening the control that they have over the branches, as well as implementing remedial measures for the same. Back to you.
Okay, thank you very much for that. Let me get to Mitesh now. A quick technical check on the markets. Mitesh, steady, but there is a lot of action and momentum in the broader markets. What have you made of the day so far, and what would your picks be?
Yeah, I think it's the broader market which is interesting me. The market is steady, but we have come off the day's high, both for the Nifty and especially for the Bank Nifty, which is now turning nearly flat. So I think there's that gap level which happened on last Monday. I think that replacement levels are seeing some kind of strong supply emerge. So I'll not trade the index, but focus on the side markets. And Quick Heal is one of the stocks which I've identified a good breakout happening over here. Buy with a stop at 498. Look for a target of 550 to begin with. We can eventually look at higher levels. And HUL, I think, is reversing from oversold levels, could give a trading rally. So HUL is a buy, here I think I would suggest keeping a stop just below levels of 22.34 and a target of 24.25 can be looked at.
Okay, all right. Mitesh got that. So we'll keep those two trades in mind. Thanks for joining in. And we'll touch base again in the afternoon. Let's move on now and focus on a couple of other stocks that are in news as well. Sudarshan Chemicals has been rising higher. Sonal is here with the latest update on the stock. Sonal, what's happening?
Well, there is an update which has come back in the global markets. One of the big players in the pigment space, which is UBAC GmbH, which is required to file for insolvency in the global markets, and they filed an application today to do just that. And that is the reason why Sudarshan Chemicals is surging in trade. Now, why is that? Because Sudarshan Chemicals is the third largest pigment producer in the world after DIC and this particular company. And if this company goes out for insolvency and if production is impacted, this would mean market share gains for Sudarshan Chemicals going ahead. This is as per a note by Centrum. They say it shall create a void in the interim period, the insolvency that is, and Sudarshan can strengthen its market presence across the export markets. Even if it comes back, somebody else buys it or the production facility comes back in action, Sudarshan Chemicals will still be able to gain some market shares which would be irreversible. And their specialty portfolio is anyway expanding. They have seen new products, validations, new product approvals. Their export growth has been very strong. So Centrum says this is a positive news for Sudarshan Chemicals. However, we've seen a big surge already in this stock. We'll have to see what happens with this particular company, what happens with the insolvency proceedings, and whether any production goes out of the market or not. So these are some monitorables going ahead. For now, the stock is cheering this news.
Okay, all right. Got that, Sonal. Thanks very much for the details. 10% higher. So indeed, market excited about whether Sudarshan can make the most of this opportunity with one global competitor perhaps out of action. Let's move on. Adani Group stocks are in focus. Now, Reuters has been reporting that SEBI has found a dozen offshore funds invested in Adani Group companies to be in violation of disclosure rules and in breach of FPI investment limits as well. Hormaz is here with more details on the story. Hormaz, what do we know at this point?
No, so standard disclosure first up. This is a Reuters report attributing to sources, and CNBC-TV18 is yet to verify independently the veracity of this report. But what the report says, the Reuters report, is that SEBI has found that a dozen offshore funds that have invested in Adani Group companies are in violation of both disclosure rules and also are in breach of investment limits in these companies. Now, what sources have also told Reuters is that SEBI is looking into the Adani Group ties with one of these funds, which they believe is acting in concert with key shareholders of the Adani Group. Now remember, the Adani Group has had these allegations before and they have rejected these allegations in the past. Now the sources have also said that the funds were reporting the Adani Group investments at an individual level, and what SEBI is seeking is that they are wanting the holdings to be disclosed on an offshore fund group level. So that is what the market regulator is seeking. Now what the sources have also said is that the 8 offshore funds out of the 12 of them have approached SEBI with a written request to settle the charges, but they want to pay a penalty without admission of guilt. Now this is what the story encapsulates, and as I mentioned, CNBC-TV18 is yet to independently verify this. Minimal impact on the group stocks as of now. Most of them are surging higher in today's trade.
Okay, thank you very much. Now we'll slip into a break on that note. On the other side, we'll discuss market fundamentals. George Thomas from Quantum AMC joins us next. Welcome back. As promised, let's talk markets, stocks, sectors. George Thomas from Quantum AMC is now with us on the show. George, the sector which has got a shot of life has been Vodafone Idea after the successful closure of its 18,000 crore FPO. Do you see a new lease of life for the entire sector? Stocks have already run up, but can this sector be a leadership sector in the next 2 to 3 years, in your opinion?
Yeah, definitely. The sector has become an oligopolistic structure with very limited number of players. And if we look at the kind of ARPU growth which has happened in the last 4 or 5 years, it has been fairly minimal. And if you compare our tariff with what is existing in other part of the globe, it's fairly competitive and very on a relative basis, it's pretty cheap. So there is substantial scope for ARPU to increase from here on. And therefore, the players in the space could make reasonably good profits in the next 2-3 years.
Okay, Thomas, hi. So let's just sort of talk more about that. There's a lot that's happening in telecom right now. There is a chance that we might have the third player revive. We've seen pretty steady performance from Jio in the numbers that were just released yesterday. So, how do you find current valuations? And there are tower companies as well, because if we have a more thriving market, then perhaps they stand to benefit. So how do you find overall telecom valuations, and what part of the telecom chain would you be comfortable investing in?
So we have one of the telecom player in our portfolio. And the broad logic there is, as I said, last few years, the use of data has increased multifold, and it has become more of an essential component. So our sense is, players would be able to take reasonably good ARPU hikes from here on. And if we were to assume that even the third player, when the promoters and even the other stakeholders have kind of subscribed on an assumption that we would be able to take reasonably good ARPU hikes so that even the third player can kind of sustain. So even the existing players, I don't think they would refrain from taking reasonably good tariff hikes in the next few years. So if in that context, the valuation does not appear very expensive. But of course, if we look at from a trailing earnings perspective, we may not see much room for valuation to catch up from here on. But our sense is earnings growth should be fairly strong.
Earnings growth. Okay, so that's about the telecom sector, particularly on this M&M Financial and this fraud, which has taken the stock lower. Now, 150 crore broadly is not very large for a company of M&M Financial's P&L. But should one be questioning the governance, the way the risk management lays out in M&M? Is there a broader ramification? And do you like M&M Financial in the NBFC pocket in particular?
So I may not be able to comment on stocks specifically, but when we evaluate the overall NBFC space, we tend to stick to players with either niche skills or players who have an advantage on the cost of deposit front. So we have a couple of names in our portfolio, but generally when we evaluate this space, we are cognizant that there could be most companies, they operate at fairly high yields compared to the normal ranges which we'll see in the lending space. And that is kind of reflective of the borrower profile. So we factor slightly higher than probably what the street estimates on the credit cost front. And we kind of take some bit of margin of safety on the multiples. So generally, barring select names with niche differentialities, our multiples tends to be fairly conservative compared to street.
George, what have you made of some of the early numbers that have started coming in so far? I mean, I'm now talking overall, general. Till now, we were in a bit of an earnings upgrade cycle, and that was really fueling market sentiment and momentum. What are you expecting from the fourth quarter? And generally, I mean, are you okay to hold some cash, or are you fully deployed? What is the overall approach you're taking to the portfolio?
Right. So in the last 6 months, we have had more trims than what we added, purely because of valuation reason. So our sense is broadly from an economic perspective, the economy is reasonably strong. So the underlying fundamentals remain reasonably fine. But the only constraint remains from a valuation perspective. And last few quarters, what we have been seeing was some bit of raw material moderation, and that was giving a fill-up to the margins. Despite, let's say, the volume growth or the revenue growth being muted for many sectors, we saw them getting benefit from those benign raw material environment. But going into the next year, if the Middle East crisis and the commodity spikes were to continue, it could be a possibility that we might, those margin tailwinds which we saw in the last few quarters, that might reverse at least for some time. And that could kind of constrain the earnings growth in the medium term. But having said that, that's not the base case assumption. And our sense is probably if the anyways, geopolitics is always difficult to comment. But it may not, if it does not go to an unmanageable situation, then the underlying fundamentals look fairly strong for a reversal probably a few quarters down the line.
What have you made of HDFC Bank's numbers, and what does it, portend for the entire private banking sector? Do you think the other banks too may have to focus more on profitability, the return ratios at the expense of growth, and this entire sector could be a little slow growing?
See, we are quite positive on private sector banks as a space, and it remains one of the probably the only sector or one among the couple of sectors where there is reasonable valuation comfort. So our sense is, so the largest private sector bank, of course, he has certain issues due to the specific issues with respect to his merger and stuff. But overall, as a space, our sense is, next couple of years with a favorable credit environment, things should be reasonably fine. And at some point in the next couple of years, we could see some bit of demand coming up even from the corporate credit space. And then that should ensure that, their margins and the growth comes back. But of course, the liability franchise would be a key differentiator, and that has to be evaluated from a case-to-case perspective. But from an overall sector perspective, we are fairly comfortable at these valuations, and our sense is, this is probably the time to add more to the space.
Okay, all right, George, we'll leave it on that note for today. Thank you very much for joining in. Good to get that perspective from you. The market's holding up. I mean, the Nifty has not moved much from the last time we checked it, still about a 50-point gain. So in that sense, it's quite okay. The advanced decline ratio and the broader market, that continues to be the story. Let's pull up the advanced decline lines. You've got over 1,500 stocks advancing, just about 700 stocks declining. So it's a very healthy looking screen, and it's holding at that level. Let's take that break. And as we take that break, here's the announcement. We're launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate. Personal Finance Handbook with Sonia, where she'll be joined by 3 well-known experts on Saturday. That is the 11th of May. We will be diving into everything you need to know to master your finances and to learn to grow your wealth, be it insurance, tax savings, managing your portfolio, retirement planning. There's lots to learn.
Absolutely. There is lots to learn, lots to do, whether in your 20s, 30s, or even 40s. This live webinar is for you. And remember, we have limited seats, so don't miss your chance. Register now. Scan the QR code to register or log on to CNBC-TV18.com. And we will see you on 11th of May, 9 a.m. Welcome back. Index provider MSCI will be announcing the results of the May Index review on the 14th of May 2024. Vivek joins in to tell us which are the likely candidates that can make the cut this time around. Vivek.
Well, that's right. So, already India is now seeing a much increased weightage in the MSCI Emerging Market Index on the back of the improved performance of all-round equities. In this particular index review, like you mentioned, it's scheduled on May 14th, 2024. The adjustments will happen on the last trading session of the month of May itself. 15 likely additions are the ones that could make the cut this time around. Which are the stocks that could see the maximum inflows? Look at names like Sundaram Finance, look at Thermax, Jindal Stainless, Phoenix Mills. All of these stocks could see flows anywhere in the range of $140 to $200 million. Also look at names like Mankind Pharma, Bosch, PB Fintech, Solar Industries, Torrent Power. Again, a high probability inclusion into the index this time around. JSW Energy, Canara Bank, NHPC, Industar, a couple of more names at the end, Zydus Life Sciences and Dixon Technologies. These are medium probability names, but they too could make the cut this time around. All of these estimates are from IIFL's alternative research. On the other hand, the stocks that could get deleted from the index this time around on the back of weak price performance are number one, Berger Paints. You could also see IGL and 197, that is Paytm. That could be removed from the index this time around. Likely to be a net inflow event on the back of much higher additions that could be seen. There will also be a few stocks that could get added as far as the small cap and the mid cap index are concerned, that we will get to know a little later. The reason we are highlighting this particular set of stocks today is that the cutoff date most likely was on Friday, the week gone by. So the stocks most likely have already made the cut as far as the MSCI index review is concerned.
Okay, thank you very much for that. We leave the Nifty inching towards that 22,400 mark, a 60-point gain, while the mid-cap index is now approaching a good 1% rally. Steady Tuesday morning so far. With that, we're going to take your leave on Trading Hour from the entire team. Thank you for watching. Halftime report is up next.